Well, certainly we've talked a lot about, I've been focusing a lot about the LBMA. I think that's where you can see much of the stress. You mentioned record low volume or inventory. We call that the float. The float is what is available for delivery, backing the bars that are, or the paper that the bars that are backing the paper certificates. They have right now, I believe, about 155 million ounces of silver. That is the lowest volume, the lowest float they've ever had since they started keeping records. This is a 140-year-old exchange. Now, I don't know when they started keeping records, but I do know it's the lowest total since that point. Um, and what's interesting is they admit to trading somewhere in the neighborhood of about 180 to 190 million ounces a day. So they're trading more than the stated float every single day. But David Jensen, who does a marvelous job of analyzing the LBMA intricacies and you know the inside and out of the LBMA, and he says, well, actually, that they have admitted to trading 10 times that amount, as they only post the final settlement numbers the day that would equal 190 million on average, but they're trading throughout the day upwards ends of 10 times that amount, which would mean they're trading 1.9 billion with the B ounces per day, which in this case is almost 15 times the float, 3.5 times the annual global mine supply. This is why they went from a T+1 settlement exchange, where T is the trade day plus one settlement day. The third day the bar should be moving to you. So if you own a company that produces and manufactures jewelry all around the world and you have LBMA contracts and you need your silver and gold to make your jewelry, sorry, Slayer, you know, we're going to be 8 weeks delayed because, well, we're the Bank of England and we don't have enough in the way of manpower or trucks right now. That's what they've wanted us to believe for a while. It might be getting a little better, I don't know, but I can tell you that the delays coming out of the LBMA signal to me, in essence, a soft default, where the reason they don't have or aren't able to deliver the silver isn't the fact that the Bank of England can't come up with trucks and manpower. It's that they don't have the bars to deliver when they need to without blowing up the system. But this is something that we're seeing, not just there. We're seeing it in other places too, and we're seeing it in platinum as well. And speaking of the LBMA, before I get to that, and how platinum will spill over, you know, it's funny. The LBMA just came out with a warning saying that counterfeited silver and gold will distort prices by creating artificial supply. I almost fell off my chair when I heard that.
What?
I'm thinking to myself, yeah, so they say there's beware of counterfeits because this distorts prices and creates artificial supply. Then I'm thinking to myself, but isn't this the same company that sells claims on gold and silver that can't deliver? Doesn't that kind of sound like counterfeiting
Right.
or trading billions in unallocated bullion contracts backed by nothing? Isn't that the same thing? But anyways, I thought that was funny. But there was a man, I want to read to you something here. His name is Bruce Ikemizu, Ikemizu, formerly head of Chinese bank ICBC's Tokyo Precious Metals Desk, and now head of the Japan Bullion Market Association. Bruce says that the market may already be broken. He more or less says that London and Switzerland appear to have virtually no physical platinum available for delivery. And he says it seems that there really is no platinum in loco, meaning location, loco, London, or Zurich. Yet the exchange continues trading nearly 3 million ounces per day. So what's that, $3 billion roughly? Even no, 3.5 billion? No, what would that be? 1,400 times what? 3 million? So what?
What would
Okay,
you
so
say?
it's like 1.2 or $3 billion
Yeah.
worth a day of so he says they're trading 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery. Something is about to break. You mentioned the 7 or 8% lease rate in silver.
Yeah.
It's 30% in platinum. And he says, you know, paying 30% interest to borrow platinum makes it unreasonable to consider unreasonable to consider just buying it outright, says Ikemuzu. I cannot recall a time when lease rates rose this sharply. So it's 7 or 8% in silver and it's 30% in platinum. That means if you have to borrow for a 1 month contract in order to cover, you're paying 7 or 8%, or in the case of platinum, 30. Behind the banks, he says, are the actual users who borrow from them. He says mining companies, recyclers, jewelry manufacturers, and industrial users. Now, here's the part I wanted to read to you. The revelation of the frailty of the London platinum market can and will most likely knock onto the other London metals, such as silver, that are also traded at leveraged cash contract promissory notes, thus lifting the veil on one of the biggest market frauds in history. And to your point, silver is now seeing a concurrent surge in its 1 month lease rate to 7%, 1 month for 7%. So, yes, and we are seeing an explosion in the exchange for physical, the premium that is exploding. And now it's kind of contracting where it's moving towards backwardation, where just all of a sudden, where the front month silver that is available is actually priced higher than the futures, which is abnormal. And that basically says that, well, we don't trust the future. We want it right now. So there's a premium to get it right now. Normally, you pay a premium to get it out in the future, which is the time value of money and the increase in the market. But to get it now is actually more, almost to the point where it's in backwardation, where it costs more than it does out into the future. So the market is all messed up. And then you put that into context with the largest deliveries in COMEX history, month over month over month, in gold and in silver. The silver market is changing. I look at it from a technical standpoint, Jay, right where gold was about a year and a half ago. And I think it's poised to make that breakthrough. It is acting very differently. We don't see those smash downs. It's trading within a range, and then you know, and it's just bound to take off on so many factors. This just being one of them, the tightness in the market above us. Well, I think it actually, it's the end of the day today. I think the new contract comes on tomorrow.
Okay.
So I think they've already pushed the price down to the level that they were trying to keep it under, or close enough anyways. They put on a 440 million ounce short position, they being, it's interesting, I'll tell you that in a moment, but whoever they is, because Bix Weir was talking about the fact that the commercial banks, their playbook is traditionally to short a rising market. And this time they didn't short the market as it went up to 39. He says it's a classification on the Commitment of Traders report that is other traders or unknown traders. They're masked. We don't know who they are, but the commercials did not short. Whoever the hell it is this stupid game that the COMEX continues to play. They did knock it down, and you know, the commercials did put at some point a couple of weeks ago, they did put on 440,000 ounce short at 37.50. But then the price went up and they didn't short it. Someone else did, whoever that someone else is. Maybe it's the BIS. I don't know who the hell it is, but whoever it is, they're stupid as a mud wall. So at the price right now of roughly, what do we got? Roughly on silver,
38.19 or so.
Yeah, so they're roughly $500 million right now in the hole. Not quite. No, half that. About 200. They're $250 million. About $250 million that they're bleeding at when it was at 37.50. That's when 440 million ounces were sold short. But there's a 90% correlation between silver and gold throughout all of history. I look at silver right now from a technical standpoint to where gold was a year and a half ago. I think it's ready to explode. And then you look at what's happening in London, as an example, with lease rates that have blown out to 8%, with exchange for physical premiums that have blown up by 250% in 2 days last week, where most of the last 2 weeks there were 0 shares available anywhere in the market to buy of SLV, to cover or to short. All of this screams of tightness in the silver market. And when you realize that in London right now, that the platinum lease rates, I know you asked me about silver, but it's tied in, and it's tied in because the platinum lease rates right now are nearly 30%. And the head of the what am I trying to say? The head of the Japanese, I guess it's the TOCOM, the Tokyo bullion market, he came out and says that in his mind, London appears to have virtually no physical platinum available for delivery. And he says, I'm going to read it here. He says that it seems that there is really no platinum in local London or Zurich, yet continued yet continued trading of nearly 3 million ounces per day of London promissory note cash contracts for immediate platinum ownership and delivery is something is about to break. And he goes on to say that if you're paying 30% interest to borrow, you might as well just go out and buy it. But really what he's going on to say is that, and he also said he's never seen a time. He used to run the trading desk for ICBC, Chinese bank, but he says the revelation of this and the frailty of the platinum market will knock onto the London Metals silver market, and the rates are there are 7 to 8% lease rates. It's going to shine a light on it. In other words, all of these markets in platinum and gold and in silver that have been suppressed in London and in New York for such a long time is being exposed by these big traders that are global, that are sovereign wealth funds for Saudi Arabia, for China, or for India, or for Russia, whoever the hell they are, they're standing for delivery. And they are using the stupidity of the West and their continued manipulating of the market to drain what's available. It's changing. The market is not behaving anywhere near like it used to. And if you see a 7% 1-month lease rate for silver, that's something I've never seen before. So the market is getting very tight, physical supply. And I would expect that if gold goes to the moon, silver will slingshot. And look, if you just use the silver to gold ratio, you got all the banks saying $4,000 gold by the end of the year. If you realize 50 to 1, it's been higher than that on par for the last 150 years on average. That puts it at $80 an ounce. Even at 70 to 1, which is way higher than its average for the past 150 years, you're at 60. So yeah, I do think that silver will go much, much higher than people think possible. And from a standpoint of technical analytics, it's right where, almost identical to where gold was just about a year ago. We could expect it to break through the resistance, just like gold broke through 2,200 and then went off to the races, gaining another 50%. I would say that's what you should expect to see, and maybe even much more because of the suppression of silver so overtly for so long that really, not to mention the resistance between here and 50. There are a couple of spots at 42 or whatever, but those numbers were only, you have a couple weeks or less of trading time cumulative in the two peaks before, went up, went down. And so those resistance levels are quite meek as far as I'm concerned. Once it gets up into, the upper 40s and does break through 50, if it follows gold's suit, well, you'd see it at 75 in no time. And 75 would simply be where we are right now, about where it should be based upon 150 years of price action. And that would still be, if we took 3350 divided by 75, that's a ratio of 45 to 1. That's about where it's averaged for the past 200 years. It's coming out of the ground at 7 to 1. It's still 6 times higher than it's coming out of the ground at. So is that reasonable? Yeah. And the whole reason that it's been held back for so long and underperformed is because it's far more significant than an industrial metal. It's strategic, and that is beginning to, I think, be understood. Jared, the only way you can successfully manipulate a market for an extended period of time is to push it in the direction that it is going. In my entire career, there hasn't been this level of understanding and demand at the upper levels where central banks and sovereign wealth funds are draining the world's exchanges before the public catches on. The public is record numbers in equities, record numbers, higher than the '08 crisis, about 54%, the retail investor. Virtually no exposure to commodities, whereas the big money is leaving in droves.
Yep.
The equities. Bezos is up to $6 billion in sales. He's been selling like crazy since the end of June, along with Buffett and Jamie Dimon and Zuckerberg, and all of these big insiders are selling. The institutionals, traders, have been selling about $2 billion a week since June. They're all leaving as the mom and pa's in full force, all in. What could possibly go wrong? It's the opposite in commodities. They're all standing for delivery at the highest level, and the public has no exposure. So you talk about contrarian indicators, never seen a better one. Silver to me and platinum are as good of a value as anything you could put your money into. In my mind, when you talk of asymmetrics, the lowest downside, highest upside, to me it's a no-brainer on both. I'd say the same thing about gold, but it's just because the public is completely asleep as it pertains to the merits of that and think the road to retirement is only paved with NVIDIA stock. By the way, three or four of their biggest traders or shareholders and board members have sold hundreds of millions of dollars worth in the past month of NVIDIA. So when you get all these insiders selling, what does that tell you about what they all think the future holds? I don't know. I'd rather be on the side of the insiders because information is worth a lot when you at that level because you know where the ball's going.